afternoon, everyone. I'm Bob Frenchman. I'm a partner in the law firm of Dynamis LLP. I'm a U.S. lawyer, and I litigate cases against federal prosecutors and securities regulators and private litigants. And our topic today is building trust in digital asset markets, regulation, institutions, and the next decade. And it could not be more timely. We are at the forefront of some major changes in these markets, and I think we can all agree that this is a very exciting time on the regulatory front. Markets are opening slowly, clarity is coming slowly, and I'm surrounded by some true luminaries in the space whose insights on these topics are extremely valuable. So let's jump in. Ken Kawai will be our first speaker. He's a partner in the law firm of Anderson, Mori, and Tamotutsun, a law firm here in Tokyo. He is a premier authority on Japanese law in the digital asset space. He's represented the full spectrum of fintech companies, blockchain companies, banks, broker-dealers, and other financial institutions. Kawai Sensei, please enlighten us on the most recent regulatory guidance and market updates on stablecoins and digital securities, and tell us about the development of these Japanese regulations and also how the industry has reacted.
Yeah, thank you, Bob. Yeah. So now let me talk a little bit about the recent Japanese regulatory development. So maybe there are a lot of, let's say, international participants here. So I'd like to briefly explain the overall structure of the Japanese regulations on digital assets. So in Japan, fiat-backed stable coins and the cryptos are separately regulated. Both are currently under the Payment Services Act as payment tools. And in 2023, stablecoin comprehensive regulation started, and it was implemented in 2024. And the cryptos are regulated under the Payment Services Act as a payment instruments right now, but the FSA, the regulator, is going to submit the law to change the crypto regulations from payment service to the investment tools. And we expect it to be implemented in the summer, early summer next year. So the stable coins can be issued by banks, trust banks, or the fund transfer service operators. And it needs to be fully backed by the reserves, fiat reserves. And some of the banks are trying to, currently the JPYC, Japanese yen-denominated stable coins, have been issued and circulated, but it's not in the big amount right now. USDC is listed on the Japanese exchange right now, but more to come. So some of the banks or trust banks would like to issue stable coins under the trust structure. It is considered as a payment tools, and the other overseas stable coins like RLUSD or the Tether or maybe others. Some of the Japanese exchange would like to list it. And then with regard to the cryptos, we consider it as a payment. It used to be considered as a payment instrument, but considering the reality, the FSA realized it's a kind of investment tools. So the investment tools, the FSA thinks that it needs to be regulated similar to securities. It's different from securities, but they are going to use the securities regulations as a model for regulating cryptos. So for instance, in order to do the public offering of cryptos, the issuer is going to be required to do the full disclosure of those kind of things. Or let's say the unfair tradings or the insider tradings would be banned, and if let's say the new regime comes. Maybe I switch to the.
Thank you, Kawai Sensei. Thank you. Next is Saito. Saito Sensei founded his own law firm in Japan, and he is a premier authority on Japanese law in the digital asset space. He's been called upon by the government to help fix the industry after the Mt. Gox bankruptcy, among many other representations. Tell us, Saito Sensei, how Japan is moving towards institutional participation in digital asset markets, what trust actually means in this space, and tell us how regulation intersects with product design.
Thank you, Robert. The movement is similar globally. More institutional players participation, and Japan is moving towards that direction by reforming crypto asset regulation to Financial Instrument Exchange Act, and more institutional investors will come. Crypto is now not just speculative assets, but will be regarded as financial products. So there are three topics: more institutional participation, becoming financial integration, and trust building. And when we talk about trust, I think there are three layers: trust in technology, trust in trust in operation, and the third one is trust in market. Trust in technology. It has been proved that blockchain has, resilience activity. Bitcoin, Satoshi's blockchain is very strong, and other chains are also strong. And the second layer, trust in operation. There are quite a lot of risks in operation. There are hacking, and there are massive hacking is still occurring. So the regulation is necessary to prevent, to make more trust in operation area. The third layer is trust in market. There are, for example, insider trading, market manipulation, etc. And this area, in order to trust in this area, regulation is necessary. And by changing crypto regulation from Payment Service Act to Financial Instrument Exchange Act, a kind of security law, Japan is making more trust in the second layer and the third layer. And in the market, there are central exchanges and DeFi's and something like that. And more institutional investors will come to central exchanges and centralized products, ETFs and something like that. But outside of the central exchanges and ETFs, there are, DeFi's and offshore exchanges and etc. DeFi's and offshore exchanges are riskier than central products, but there are many emerging products in DeFi's and offshore exchanges, and these two layers, central products and outside of central products, these two layers go on. Will continue to go on in parallel. That's my understanding. Thank you.
Thank you. So next we have all the way from the Cayman Islands, we have Marc Piano, who comes to us from Horizons Global. And Marc is an independent director and consultant to some of the world's most active and influential Web3 foundations. He oversees governance, compliance, and long-term sustainability at the highest levels of the digital assets ecosystem, especially in the offshore realm where he resides. So Marc, give us a brief survey of that world and tell us why offshore options are so heavily used in this space.
Thank you very much, Robert. And I wish we had more time because I have so many questions for Kawai Sensei and Saito Sensei about these reforms. So the question here, and I'm going to go fast and wide and deep on this area, so bear with me because I've only got 4 minutes and 45 seconds.
You've got extra time, actually.
Oh, I'll speak a
we're
little
ahead
bit.
of schedule.
Oh, wonderful. I'll speak a little bit more slowly then. So Cayman Islands and offshore jurisdictions are used in multiple ways. From a regulatory point of view, the Cayman Islands is the world's leading funds jurisdiction with over 30,000 funds. They've just passed legislation to allow for tokenized funds, which could be of interest to the Japanese market. But they've also, in previous years, passed legislation to allow Japanese funds to slot into the Cayman regime to then offer back to the Japanese retail market, although you still have to comply with FSA requirements. Point being, the Cayman Islands, as well as being one of the world's leading jurisdictions for regulated funds, virtual asset service provider regulation, and other regulated financial activities, has also very quickly in the last 7 to 8 years emerged as a leading jurisdiction for Web3. The answer for that is because of a structure called a Cayman Foundation Company, which is basically a corporate trust vehicle, and it doesn't have to have any members, which to Saito Sensei's point is great for decentralized products because you don't have any owners or controllers of these decentralized protocols if you have value accruing to token holders. So if it's very relevant for these potential new reforms which are coming in Japan, but also as a standalone offering in itself, because it's often used by companies who want the rest of the world to interact with their exchange or their product or their protocol. Just because you're set up offshore doesn't mean you don't have to comply with local laws, and FATF and other bodies have quite obviously made that very clear. But it's a lot of different benefits for structuring, for friction and ease and speed of doing business, but also in a jurisdiction that's already very well recognized globally for having strong standards and regulation and oversight. So for offshore, it's used for rest of world facing, it's used for token issuances, treasury management. But as more and more institutional capital and players move into this space, they're looking for good governance. They want to make sure there's good conflict of interest policies in place, KYB, KYC, AML generally, as well as insider trading, MMPI, public disclosure information, and so on. And so you have service providers with a deep level of experience in Cayman and other jurisdictions who are able to not just help you navigate the regulatory side for your product, but also if it's not regulated, make sure it's structured and flowed properly as well. Not as a workaround to the law, but to make sure that everything works in the way it should, rather than trying to circumvent. It's been going for many years now. The other jurisdictions include the British Virgin Islands, Panama. I was talking to some people in the room here last night who have structures in the Cook Islands and the Marshall Islands and St. Kitts and Nevis. I can't really speak to those because I don't have that much experience. But offshore has a part to play in Japanese projects that are based here and operating here and have teams here. It gives them more optionality and flexibility to offer products to the rest of the world while still complying with global standards and regulations. So it has a part to play, it's complementary, it's also quite straightforward to set up. There's tax neutrality as well. Tax neutrality is not the same as no tax. You still have to pay tax in the jurisdiction that you're domiciled in. So that's a quick survey of the offshore market, and hopefully that helps to slot into the topics that our esteemed panel have been speaking on and will be speaking to.
Thank you, Mark. Excellent. Our next speaker is Ben Tsai. He is the co-founder and president of Wave Digital Assets, a major SEC-registered investment advisory firm. He's the only non-lawyer on the panel. It's an honor. He's been managing money in the digital asset space for more than 20 years for major institutions and issuers, and also teaches crypto finance at UCLA. He's also a veteran in the financial services world, having held senior leadership positions at Merrill Lynch and AllianceBernstein. Tsai Sensei, please enlighten us on the changes taking place in Japan and the US, and then I may have a couple of follow-up questions for you.
Great, thank you very much. Thank you for having me at this conference. You know, as everyone mentioned, I'm the only non-lawyer here, so I'm actually just users of these regulations as opposed to kind of being at the formation level. So I'm actually very excited with the progress of kind of these regulatory changes, and we're really seeing a lot of progress both in the US and I would say in Japan also with regards to securities laws, with regards to you know, categorization of crypto. I think that's something Robert's going to get into more, so I'll kind of not talk about that right now. There's also a lot of discussion around stablecoins, which I think I can comment a bit on, which I think is very interesting. So, you know, we've had you know, quite a number of different iterations of stablecoins, you know, kind of in the U.S. and internationally, and I think it's kind of heading towards a more regulated space. You know, I had the pleasure of bringing the Wyoming Stable Token Commission to Japan. We went and visited actually Kawai Sensei and a number of the financial institutions to discuss, you know, what Wyoming's doing at a state level. We've also had, you know, various discussions in the U.S. with regards to the Genius Act, which is, you know, around stablecoin issuance. The funny thing around the Genius Act was that it wasn't very specific with regards to interest paid directly or indirectly, and I think that's now leading to kind of a bit of kind of back and forth with the Clarity Act. I think one of the major hurdles around passing the Clarity Act is around the fact that it's a very divided opinion between people who want you know, interest to be available to be paid out and people who don't want that. And I think generally, I think the lawmakers are leaning towards not paying that out, but I think that's, you know, the crypto world is pushing towards having interest rates. So I think that is actually very interesting in terms of that divergence. And, you know, as a crypto person, I do have the general feel of, yeah, please let us do whatever we want. But on the other hand, I do understand that by, you know, having an interest rate paid out is really shortcutting the interest rate process from really the U.S. government, the Fed window, all the way directly down to a retail level. And that is a great tool to have, but it's also potentially a very dangerous tool because you're bypassing all the banks in the middle and so forth. And I would say a lot of crypto people would say, yay, that's exactly what we want, but I'm not necessarily sure that, you know, a lot of the crypto people have thought through the implications of that. And, you know, for example, I think banks currently, you know, in the U.S. serve as a multiplier of capital where, you know, it's on a reserve system. So more capital is lent out versus the capital that's coming in. So, you know, some crypto people say that's not a good thing, but it does increase the amount of money that flows through the industry or the finance industry as a whole. If we went to a complete one-for-one backing, you're actually shrinking the whole economy of the U.S. So that's not something to be taken lightly. So I think the regulators are looking at things like that. You know, regulators are also looking at regional banks who may not have a revenue stream from this if everybody went to stablecoins. So those are all issues that they're trying to overcome in trying to come up with you know, a proper path through the Clarity Act. So we'll kind of see how it goes. And I think kind of a vote in the cryptos you know, side. I'm not sure that it matters which side the Clarity Act lands on. I think there's so much financial freedom within the crypto space now that you know, there will be methods to be able to pay out interest rate and a rate for having these dollars. So I'm not sure that that in itself is a problem. One last thing I'll mention before I kind of wrap up here is I do think that there's a lot of progress outside of the regulation side and outside of the stablecoin side. And this is true both in the U.S. and in Japan. And in Japan, I've been coming here actually almost every other month. I was attending the stablecoin conference in Japan, and there is a lot of progress here. I also heard a lot of progress in Korea when I was at Korea Blockchain Week and so forth. So there is generally an interest in pushing more into this space. And that push is not just on the regulatory side, but also on the financial institutions themselves. On this trip, I went and met 4 different exchanges. I met a number of banks. I met a number of major securities firms really in the TradFi space. And everybody is interested in pushing into the space as more clarity comes on. And I was actually kind of shocked at how much progress they've already made internally for plans, which aren't announced, but they are pushing forward in that direction. And that gets me excited. It's probably more than in the US. There are some major financial organizations we speak to in the US that are still frowning upon crypto. And I didn't get a sense of that when I'm in Japan going through on this trip. At the same time, for Wave, we've recently structured a bond where we got a rating from Moody's for the very first time. It's a municipal bond that has a Bitcoin link to it that's got a Moody's rating. So we're very excited. We think the regulation, the rating agencies are also coming for the ride, and they're ready to tackle crypto and look at crypto collateral and so forth. It took us 8 months to get that, but we got that last week. So I'm actually quite excited that they're coming along for the ride too. So I'll wrap up here, but hand the mic back.
Excellent. Well, congratulations. I was going to ask you about the Bitcoin-linked municipal bond. Certainly an instrument I was not already familiar with, for sure. So let's turn to the United States. I think it's a very exciting time for digital assets in the United States. As I think everyone here knows, there's a new presidential administration. And this new presidential administration prides itself on being crypto adjacent and crypto friendly. And so there's a new sheriff in town, for sure, in the US. And that means, among other things, that the regulation by enforcement era is coming to an end. It's the end of, we're not making rules to guide you, but we will charge you when you fail to register as a securities dealer. That was the, climate with Gary Gensler at the helm of the SEC, and that's coming to an end, thankfully. US regulators have now taken steps to provide the market with affirmative guidance on what digital assets are securities, what digital assets are commodities, and why. And so the process has begun. In March of this year, the SEC and the CFTC, those are the 2 main regulators in the United States. The SEC covers securities, the CFTC covers commodities, issued a joint interpretive release, and it's a functional framework. They call it a taxonomy for the regulatory classification of digital assets. And this is a very new thing in the United States. There are 5 relevant categories that everybody should understand. The first is digital commodities. And those are digital assets that are intrinsically linked to and derive their value from the programmatic operation of a functional crypto system, rather than the expectation of profits from the managerial efforts from others. Some of you may recognize that language from the Howey case, decided 100 years ago. So digital commodities, and the SEC and CFTC actually named some. They include Bitcoin, they include Ether, they include Solana, and a bunch of others. And these are commodities. They are not securities, according to US regulators. And so that is a big win for those issuers. The second category is digital collectibles. And these are digital assets designed to be collected. They may represent artwork, music, videos, trading cards, even cultural references. That is how they derive their value. Again, they do not derive their value from the efforts of others. And these are not securities, according to US regulators. The third category is digital tools. These are digital assets that perform a practical function. They may represent membership, tickets, credentials, title of a real estate property. They derive their value from functional utility, not, again, the managerial efforts of others. They are not securities. Even if you can resell them, still not securities. Stable coins is the fourth category. Most of you know what they are. In this release, stable coins are defined in the Genius Act, and they're statutorily excluded from the definition of securities. Stable coins in the US have to be backed one-to-one by dollars or low-risk assets, and they must be redeemable for their pegged value, and they cannot pay interest or yield. They are not securities. The last category is the category that is securities, and those are digital securities, sometimes called tokenized securities, and they're securities represented by a digital asset. They're subject to the full panoply of the federal securities laws, and they are regulated by the SEC. Now, the wrinkle here that I'll get into is that a digital asset may be sold as an investment contract, which is a security, when the issuer promises to undertake managerial efforts from which the purchaser would reasonably expect to profit, right? But a digital security doesn't have to stay that way. This is a new concept, I think. It can separate when those promises are no longer connected to the digital asset. And when this happens, it becomes a digital commodity. And this was a distinction made by Judge Torres in the Ripple case in 2023. Some of you may be familiar with that case. Sales made by the issuer with reliance were understood to be fundamentally different from sales made blindly in secondary markets, right? From people you don't know. That's a huge win for XRP and others whose digital assets are sold to institutional buyers, but then go on to trade as commodities in a decentralized market. One other comment about the interpretive release, the SEC and the CFTC have signaled that mining, staking, wrapping, and airdropping do not generally involve transactions in securities. Also, a huge win for the industry. So really, it's a new day for digital assets in US markets. And the administration has been watching crypto companies leave the United States for years now. They don't like that. They want them back. They know that the US has to provide regulatory clarity. I'm not saying there won't be changes to these standards as we go. I think that there will be. The standards are fluid. They could be changed by Congress. They could be changed or they could be rejected by courts. But US regulators know that they must provide the industry with regulatory clarity, affirmative guidance, and real standards. That is vital. I think everybody on this panel would agree. And the US regulators have begun to do that. They've taken a very big step. They aren't all the way there, but the light is green for digital assets in 2026 in the US, and I really think it's a new day, and I'm, at least for me, I'm very excited. Really appreciate everybody's time. That concludes it for this panel. Thanks everybody for your time and attention. Thank you.